Hi, this is Randy Finney with Right Side of the Chart, and today is Thursday, March 9th, 2017. In this video, I wanted to take a look at the S&P 500 and do a sector breakdown. So what we'll do, I just wrapped up a video which should be posted probably by the time you're reading this one, or listening to this one, I should say. I did coverage, an update on the broad markets, and pointing out very similar chart patterns on all of these, the same story, divergent highs, rising wedges, trendline breaks, and things that I'm watching for. And I've also, earlier today, I put up a pretty detailed post making the case for market breadth deterioration in the market internals, and how fewer and fewer large cap stocks tend to be holding this market up. And from time to time, I'll do videos on the NASDAQ 100. I like to go over the top 10 components on the NDX or the QQQ. The QQQ is a tracking ETF for the NASDAQ 100, because the top 10 components make up over half the returns. So I'll do videos, and I have done a few recently. But what I want to do today is something a little bit different. I want to go through the sectors of the S&P 500. Now, you can go directly, a quick Google search will bring this up. This is straight from the S&P, Standard & Poor's Dow Jones Indices. This is their website showing you the sector breakdown, so this is accurate. Technology at 21%, financials at almost 15%, healthcare at 14%. You go down the line, you can see, and here's also the weightings right there. So that's what the S&P 500 is made up of. And there's also this neat link. This is the URL is sectorspdr.com. Well, there's actually, then you have to get in there and navigate to the sector tracker. But this is interesting because this is a tool that will show you all of the sectors in the S&P 500, including the ETFs that track those. And you can see today, for example, the big loser was the real estate sector. REITs were down about 1.28%. And it shows you a few sectors that were up. What's interesting to note, when I click 5 days, so now we look at the last 5 days, this is unusual. Here we are near market highs, but the selling has been persistent. You know, I know to some out there it appears like this market won't roll over. I just completed a video that shows that it clearly has been in an unmistakable downtrend all month, and then we're only in the ninth day of the month. It's March 9th, but since the market peaked on March 1st, we have clearly moved down. Every index out there, whether it's large caps, small caps, micro caps, they're all in a clear downtrend. And this shows it as well, but this also shows something odd. This is broad-based selling. Usually if you see some profit taking in, let's say, the high-flying tech stocks, you'll see money flock into utilities, or REITs, defensive sectors, and we're just not seeing that. Healthcare, there's a defensive sector. So we're seeing pretty much broad-based selling anyway, something to note. But again, you can take a look at these sectors. I might have, in my watch list, I think I'm using IYR in lieu of, maybe I do have XLRE in my list. I'll have to check here in a sec. Okay, I paused the video to check something. Some of you might recall just a few months back, if I remember correctly, it was in the fourth quarter of 2016. There was a big change, one of the biggest changes to the S&P 500 in a long time. They took they stripped the REITs out of the financial sector. The REITs used to fall under the financials. So now, looking at the sector tractor, sector tractor. Oh my gosh, sector tracker. I'm sorry about that. We have XLRE now, which is that's S&P's ETF. I like to use IYR. It's a little more established, but that was added in. So I just added the REITs to my watch list because, again, I thought there was something odd here. I had 10 in my watch list before. There were 10 here, but there's something different, and I don't see telecom here. So I'll get into that as I go through the holdings. So here's my watch list right here. XLF, starting out with XLE, XLV, all of the ones that you just saw in there, including XLRE, and then I'll talk on IYR, which is a more popular. It's been around much longer than XLRE, and it's a more liquid ETF covering the REITs. And so let's just dive into these in no particular order. Just have them sorted this way, starting out with the financials. If this chart does load, here it goes. I've talked on this one quite a bit. This is, I think, one of the more promising sectors on the short side. Everyone loves the banks right now, and that's one reason that I don't. I think it's a crowded trade. I think a lot of the benefits of the potential repeal or whether it's full or partial of Dodd-Frank, has been priced in and then some into this 30+% rally since the elections. And I see a clear bearish rising wedge, clean negative divergence down here, bearish cross confirming that divergence, and I'm looking, this is my measured target right here, so I'm looking for a sizable drop in the financials. And again, the theme in this video, other than just going over these individual sectors, is how well the charts and the chart patterns mesh with what I just covered in the previous video on the broad markets. Clean negative divergences, bearish rising wedges, and we're dancing right on top of not only close to these trend lines, but we're at the point within rising wedge patterns. If they are going to break down, they usually do. Somewhere here around 65 to 80% or so. It's not a hard rule, but towards this point of the apex of the wedge. They usually don't break down too early within the wedge, and they usually don't break down right at the apex, although anything's possible. But this is what I call the sweet spot. So these things are ready to pop any minute now. That's the financials, one of my favorite, and I'm personally already started taking short positions into that over the last week or so here. Next up is energy. Most of you probably know oil got clobbered over the last few days. Oil had been trading in a multi-month, very tight sideways trading range. I kept getting a lot of opinions on the trading room, or requests for my opinions. And I just said, look, it's in a sideways range. I can't make heads or tails. Those things can break either way. And it definitely broke to the downside yesterday and had further follow through today. Nothing but bearish price action in the oil stocks. Why'd I talk about in oil prices? And of course, the energy stocks, just like the gold mining stocks follow the metal, the energy stocks are going to follow the price of gold. If you don't believe me, just take a 10, 20-year chart, put up correlation, overlap the chart of crude oil prices and XLE or any of the big oil companies. So this confirms the breakdown so far in crude oil. And unless that proves to be some vicious bear trap / false breakdown, and again, there's here, I'll just show you real quick on USO if you're not familiar. I mean, this was, forget about this line. This was a potential triangle pattern I had. You can move this around, but most importantly, what I was looking at here, I'll give you a clean board and show you, is this sideways trading range right here. Very tight sideways trading range over the last few months, and you can see the impulsive breakdown yesterday and then follow through today to the downside. That is nothing but bearish. You cannot spin that any other way. So, we're quite oversold in the near term, so snapback rally is possible. But I just wanted to talk about oil because any coverage on XLE would be incomplete, in my opinion, without looking at where oil prices might be heading, just as trying to trade or analyze the gold stocks is futile or incomplete, if you will, without trying to get an accurate measure on where gold is going. So there's XLE, numerous reactions on this purple uptrend line, a breakdown, back test today. Even if it regains this purple trend line, you have some pretty significant resistance there at 71.62. They had a divergent high back here, not on the RSI because we had this extreme overbought reading, but we did have divergence on the PPO at that high. So not liking the outlook right now for the energy stocks. And remember, they're an important component of the S&P 500. That's the whole point of this video. XLV, healthcare. Let's see. This chart tells me a lot. It's just a pretty clear pattern of uptrend lines, rising wedges in this case. I don't have it drawn out. There was a divergent high there. It goes a little off to the left of the chart. You can see it on the RSI, followed by corrections. There was a mini crash there. That's why you have that long wick, but it was still a big drop. I mean, that was the actual lowest print that day was down there, but most of the action ended here. And then you had, I mean, that's where trading normalized, and then you had another low there. So really from this point to this point, that played out for that correction. Trendline break, back test, correction. Nice well-defined uptrend line / rising wedge, breakdown, back test with a little minor uptrend line. Really that's, part of this larger pattern here, the breakdown, the back test, and then boom, correction. Another uptrend line, not so well defined, but more importantly, you have a divergent high. I'll draw it out for you here. You can see the divergence. Yeah, you can almost see it's about equal, a little overbought there on the RSI, but very sharp correction. And we had, a bullish breakout. We had a downtrend line here, broke out back test, and a very steep, almost artificial ramp. When you see these very tight, thin, tight trading ranges, These usually don't end well. And more importantly, just looking at history, we're going back 2 years here, and I've drawn out all these clear, well-defined trend lines. You can see what happens after each and every one broke down. Well, what has happened here? We broke down and back tested. Let's zoom in a little bit so you can see it. Well-defined breakdown. We haven't made a full back test yet, so maybe we go up a little higher, and it's not coincidence either. I'd be remiss not to point out that we failed exactly at the previous reaction highs. So far, this is just a double top, and those previous reaction highs act as resistance. So this is the healthcare sector. It wouldn't surprise me in the least to see us maybe go up here and punch out, especially because healthcare is a defensive sector. It looks like the last couple of days it's been catching a bid. Institutions will flock to these defensive sectors if they think there's going to be a correction in the economy or in the markets, or even dip in the economy or anything else. But if it does, if we do break out and make a marginal new high, we could back test. Now, the tough things about steep trend lines, I don't have any desire to short the healthcare sector, is we can back test at a much higher level before we roll down, but that's something to watch. And we may not have to back test. Most important thing is the breakdown has occurred just as it did back here on all these other trend line breaks, and we had corrections afterwards. Tech is, as I mentioned, the biggest sector in the S&P 500. And it's most of what's comprised in the NASDAQ 100. It is just about all of what's lifted this market. Without a doubt, the tech stocks have been the primary driver. I often show you my QQQ watch list top holdings. This mirrors. If you guys type in, if you use TC2000, or you can check it anywhere, go to the website, look at the top holdings of QQQ. XLK mirrors that. Not perfectly, but very close. These are almost all the top 10 holdings right here. Or the top, let's say within the top 15 or top 10 within QQQ. So this is just basically a mirror of the Qs. I shouldn't spend too much time on it, but it is worth noting. It's a series of trendline breaks and corrections, just like everything else. And we had a little correction, a little pushback, and then a flash crash, a little mini crash, uptrend line break, correction, uptrend line break, correction, uptrend line break with a little wedge. We had a correction, more so, there was a correction in price, but more so in time, not a very big one. Now at this point we have a very well-defined uptrend line, and it looks a lot like the uptrend line on QQQ, which I just covered in my previous video. Bearish rising wedge pattern, you can see here. You can see this long building divergence in place. The divergence was negated here only on the RSI, but as I've mentioned several times recently, that not only does that not bother me or concern me, and this isn't confirmation bias, I'm not trying to dismiss what the fact these divergences were taken out. This is even a more bearish event, but to see a reading of, I don't know how high it got, it was well above 80 there. I don't think the tech stocks have ever been this overbought in 20 years or so. This is, talking about the dot-com days back in the 1999. It's crazy readings here. And but take it for what it's worth. This is a bearish rising wedge pattern confirmed with negative divergence. I don't see any key support until down here into this high. So I'm expecting a drop in XLK to at least that level, maybe a reaction there, possibly some more downside. We'll have to take that as it comes to try to quantify that for you. If you want to trade XLK individually, I'm looking at about a little over 9% drop from current levels. And most importantly, because these charts are so much in alignment, both all the broad indices, all these sectors that I'm going through that are components of the S&P 500, they're all walking the line. So I think there's a good chance we have one flashpoint, one big down day that's just going to kick off that waterfall sell-off. Because if one of these break, they're all going to break because they're so close together. All right, moving down the line, next one up, XLY. This is consumer discretionary. And you can see I didn't update this chart. My apologies, but it's pretty clear. Same story again. Bearish rising wedge, negative divergence. Perfect. This is just a great price target. So that would be my pullback target on XLY would be this, looks like about the $82 area. And, a couple zigs and zags along the way, of course. Nothing goes straight down, although it is possible. You can have a waterfall sell-off. Here's an example of almost straight down. Here's an example of straight down. Here's an example of straight down. This is certainly an example of straight down. So I might be preaching, caution and, throwing out the warning signs for a little too long now, but I would rather not be caught long in this than to either stand aside on the market or, like I've done personally, start to scale in anticipation of what's probably going to be a pretty good swift correction soon. All right, XLP. Oh, quite the messy chart. This is a component, one of the sectors within the S&P 500. Extreme overbought reading, minor trend line. This was an uptrend line. It was bullish when broken, pretty well defined. Looks like a descending broadening wedge pattern breakout and a thrust up. So there's a downtrend line. I haven't really tightened this one up, but you can see it. So we've broken down, and consumer staples are a defensive sector, because staples are something you need every day. This is toothpaste and shampoo and things like that. So that's the sector I don't care to short, and which is, it also speaks to the reason why I don't often, if I'm expecting a correction, I don't mind going long the S&P 500, especially in long-term accounts at times. You have a lot of diversity there, but when things get ugly, I'd much rather short the higher beta indices like the QQQ, IWM, small caps, because when you short the S&P 500, you're shorting all these sectors that I'm going over today. You're shorting utilities and consumer staples. No matter how bad things get in the economy, people keep buying staples. That's why they're staples. We just talked on consumer discretionary spending. This is you want to buy a Ferrari, that's going to fall under discretionary spending. You want to buy like I said, your Crest toothpaste, that's a staple. Utilities, there's another defensive sector. As ugly as things get, you're gonna keep paying your electric bill and your water bill. So that's XLU, and you can see this is a little concerning. There's been pretty big ramp up in recent months. You can see this flight to safety. It's a pattern I pointed out a couple weeks back. It seems that the institutions seem to be moving into some of these defensive sectors right now. You hear about how good the economy's doing, strong jobs report the other day, and there has been a little bit of profit taking from there, and that came after the jobs report, but yet they still haven't faded, even half of that recent ramp or movement into the utility sector. So there's, again, that's a sector I don't care to short at all. And however, here's one, industrials. This speaks to the strength of the economy. Here's the industrials ETF XLI, Roman numeral 40 for those of you that count that way. This is a bearish rising wedge, clean negative divergence confirmed. Everything I like to see. Just a beautiful little setup, and I see nothing less than a move down here to that 62.42-ish level. That's almost a 5% drop, and probably a reaction there, and wouldn't be surprised at all to see it come in a little bit more. And again, we'll have to cross this bridge when we get to it, if we get to it. In other words, when we pull back there, how do the intraday charts look? How do the daily charts look? So that's my minimum expectation. That's about a 4.85% drop. And I can easily see the possibility of an 8% or even more, 8 to 10% drop in the industrials. XLB, almost finished here. This is the basic materials. The key lines here, this upper line here that shows it's not drawn out below. It's just one long extended divergence. Again, this is like everything else, a series of divergent highs. Each in themselves have played out for corrections. You had a divergent high right here, a little correction. Some wrong tool, a little correction there. Pushed up, made a second divergent high right afterwards, corrected even more. Divergences continued. You can see them down here, and from that point, correction. And then they sort of reset other than this larger divergence right here, this high, with the PPO making a series of lower highs, and you have this new set of divergences on the RSI as well as some divergences on the PPO. So really from this point here. So there's the large rising wedge. This is the uptrend line I'm watching. We've already broken down. If we zoom in, clean out all that mess here, we've broken down, and it's been pretty not super impulsive selling, but persistent selling since then. So the basic material sector that's triggered a sell signal in my book. And in fact, I meant to highlight steel the other day and some of the other commodities that are in the basic materials sector. But that's my minimum target right there. That's about, I'll tell you, it's exactly at 49.65. And that would be another, from where we closed today, another 4.32% left downside on the XLB, the basic materials. XLT. Now, when I went over the list, it didn't show telecom. They used to have telecom in there. I guess they rolled telecom into tech. I'm not sure, but I had this in this S&P 500 sector list that I had. So I think it's worth mentioning. There's certainly telecom companies in the S&P 500, but they just weren't listed when I showed you the breakdown in the beginning. They weren't listed on that ETF list. They might have been actually on the. Let's see if they were here. Yeah, telecom 2.4%. However, they weren't on this list here. I don't see the telecoms. So it's a smaller component, but you can see a breakdown there of pretty well-defined uptrend line, negative divergence along the way, breakdown, not much else to say. And finally, we'll wrap this up with the REITs. This is what S&P used because this is one of their ETFs. Keep in mind, all those ETFs that I showed you on this list over here, these are all managed by S&P. So therefore, they're going to use. There's other ones out there. There's different ways to trade. Well, they're the big ones too, most liquid here, but there's certainly different ways to trade all of these, including the REITs. I'll just show you their take. This is S&P's REIT ETF. You can see a breakdown, not by much, by a small margin, but boy, they've really been coming under. Look at that intense, relentless, I should say, selling pressure. Not a single up day in the last, looks like 2 weeks or so there. And let's take a look at the IYR. IYR has been around a lot longer. Before I leave this, here's one way I can tell. First of all, I've been trading for years. I've never traded XLRE. I'll be honest, I didn't even know it existed until I pulled up the breakdown for this video. See these candles here? See how they're gappy and thin? That's thin trade. See how there's no volume at all? Look if you see the volume. Turn this up. This is one thing I do when I'm trading a security. If I look back, I see these choppy candles, no volume. That tells me it's new. It's been around. They're trying to build a market in this ETF, but it's not the go-to. So if you want to trade the financials, you want liquidity. You want an ETF that's been around a while that takes the volume. That's IYR. This one takes a lot more volume because it's been around. It was first to market, I believe, and at least one I traded for years. Now, so I put a little more weighting on it. You can see a similar pattern, but a very impulsive breakdown below the uptrend line there. Had a support line here. I'm not crazy about that support line. I could move it around a little bit. Bottom line, it just broke down, and there's probably more to come. And that's about it. So to just summarize everything, every sector within the S&P 500 has either recently broken down, as I've highlighted here, or most are on, if not, they're on the verge of breaking down. They have these bearish rising wedge patterns or some other type of uptrend line, negative divergences, and other signs that show that they're on the verge of breaking down. So I really can't make a case for a screaming buy on any one sector right now in the S&P 500. So that just helps affirm my outlook on the market. I hope this video has been useful. It might have been a little bit in detail, but these are the things I look at when trading. It's there's a lot to trading the markets, and one of the things I try to do when making a case, whether it's to buy or sell an individual stock or go long or short the broad markets, is to not only affirm my analysis by looking at what I want to see, but try to refute it. If I had gone through all these components of the S&P 500, especially the heaviest weighted ones, and couldn't make a pretty strong bearish case, then I might say, maybe my read on the broad market's wrong, or maybe I should step back and wait for some more evidence. But right now, everything is lining up, and you can see, this is IYR, this is a breakdown back test, and the REITs have topped a long time ago and look pretty ugly. There's a long-term chart, so if you ask me where they're going over time, they're probably going to visit the bottom of this downtrend line here. But all right, let's wrap it up there. If you guys have any questions, as always, just drop me a line in the trading room. Have a great day.